words, if you take that installment note and give it to someone else, that triggers usually an acceleration. However, if you look at Code Section 453H1, H1A, if in a liquidation to which Code Section 331 applies, the shareholder receives in exchange an installment obligation acquired in respect to the sale or exchange of the corporation during the 12-month period beginning on the date of the plan of the liquidation is adopted, and the liquidation is completed during such 12-month period, then for purposes of this section, the receipt of such payments under this obligation by the shareholder shall be treated as the receipt of the payment for the stock. In other words, translating to this, there will not be an acceleration event. This is okay. Congress sanctioned that if you were able to, when I say you, the corporate entity was able to sell some of its assets pursuant to a plan of liquidation, and now this note is being distributed up to A, that will not constitute a recognition event or an acceleration event. So that being the case, what will end up happening here, Wafa, it doesn't matter what basis the corporation had in the installment note. What will happen is A has a 50% gross profit ratio. That being the case, every payment, A gets $8,000 of cash in year one, right? How much does A have to report of that? $4,000, agreed? And now A is going to receive, I think, $1,000 for the next, or I forgot what the payment, for the next, so A is going to have to report 500 over that, and guess what? It's going to end up being where A is going to ultimately report the full $10,000, but over the full time period, whatever that time period might be. So he'll report A will report $500 each year. He'll get $12,000. He'll get $1,000 over the next 12 years, or $500 each year, and it will report a total of $6,000 more. What's the total? $10,000. There's no leakage here to the government. If it were publicly traded, can you have an installment method with respect to publicly traded stock? And the answer is no. I'll give you a heads up for those people taking federal tax accounting. 453K2A. 453K2A. You cannot use the installment method with respect to publicly traded stock. So the author's point in that question is this would not qualify. Okay? Question B, let's just talks about where the corporation is just paying cash over a multi-year period, okay? And question C is supposed to be illustrating where the corporation, in addition to being liquidated all in 1 year, okay, and getting rid of all of its assets, embedded in the corporation is an installment note that it got vis-a-vis selling some 1231 asset or some other non-inventory kind of asset. That's what it's trying to illustrate. Mabu?
Question on the basis. So basis is going to be accumulated over time, starting from year one, like 4,000 in year one, plus 500, and the remainder will go away over time. $1,000.
I'm not sure what your question is.
We recognize $4,000 of $80,000 cash, right?
On the cash, right? But we have the actual cash. So there the basis is going to be whatever the cash is, $8,000. You can't have a basis different in cash than the face amount of the cash.
So what about if A sells the notes, another party, for less than the fair market value?
If A sells the note, A will then presumably recognize the gain on the difference between the amount realized and his then adjusted basis in the note.
So the gain will be if he sell it for less than the fair market value.
No one sells anything for less than fair market value, though. So I can't answer your question because it's not going to.
On the second part where there's no installment
if there's no installment method, must recognize all 10,000 in year one. Yep. Question D. Same as the above, except the installment. And by the way, Fatima, you're raising a good point. If clients, sometimes clients want to give you hypotheticals that just are illogical or can't happen. Don't take the bait, because you're going to not come out sounding too smart if you go down that path. So Fatima, I know you're trying to just trick me a little bit, but I didn't want to take the bait. But be careful. Fatima's not alone. Clients will often, say, well, what if we do this? And if it's completely illogical, don't just yes your client and say, oh, I'll help you resolve that. If you can't resolve it, don't go there. Question D. Same as C above, except the installment obligation was received 2 years ago, and no payments have been yet made. Now, will that qualify? And I read to you that section, if you recall, and will this qualify? Does it qualify under 453 H? Okay, and if you say no, why not? It's supposed to be within 12 months, right? So this does not qualify, and that being the case, what would happen? We'd have $10,000 of capital gain all in year one. And by the way, we're not going to get double hit, because what's our basis now in the installment note? $12,000, which means that when we subsequently take each $1,000 payment, we have sufficient basis. We don't have to recognize it. So we're not going to get slammed twice, the shareholder. A is going to, under Code Section 334A, have a basis equal to fair market value. Question E. What results in A above if 2 years later A is required to pay a $5,000 judgment against that was rendered against H? His capacity as transferee of the corporation. Okay, picture, if you will, the corporation is liquidated, and out of the woodwork, someone is able to obtain a $5,000 judgment against this entity. And most of you and our clients all think the same. They think, gee, if the corporation has a liability, it's not our liability, because we all learn in corporate tax or corporate, if you guys had corporate law, but even if you didn't have corporate law, we all know, why do people form corporations? They form corporations to avoid personal liability, right? So if the corporation has a $5,000 liability, you might say, gee, if you're advising A, don't worry about a thing. Whoever has the judgment can, I'll leave out the words, but whatever. They're not going to be able to do much with that, right? But what do we know? The reality is, does A have any exposure? And the answer is, of course, right? Because as a transferee, if this corporate entity gave distributions to A, there's something called transferee liability. In other words, you cannot thwart your creditors by making this a shell company and walk away with millions of dollars and say to your creditors, oh, idiot, you didn't get a personal guarantee against me, you just went with the corporation. There is transferee liability, all right? Now, often, truth be told, this company is doing really poorly, and A never gets $1, okay? That there is no transferee liability because the corporate entity is never able to give A money. But there are cases where the shareholder does get money. Okay, so picture, if you will, that's our scenario. Someone several years after the liquidation gets a judgment and says to A, guess what? You owe us the money because you did get prior distributions in liquidation. We're coming after you. And A has to pony up $5,000. What does A want to do on A's tax return? What does A want to do? What will A be permitted to do? Okay, a loss of how much? 5,000. Now the question du jour is, what is the character of that loss? But he wants it to be ordinary, but what stops him, Allie? Come on, use your memory, guys. What did the authors say to you in your book? What did they say right next to the problem? The Aerosmith Doctrine, right? Remember in our first income tax course together, the so-called Aerosmith Doctrine, the notion of consistency, that if what did our taxpayer previously report? What character of income when this company was liquidated? Long-term capital gain. Gee whiz, you have long-term capital gain, and subsequently you have to pony up money. Consistency would demand what kind of treatment? Capital loss. And you can't cite to a code section. You have to cite to a judicial doctrine. In this case, the Aerosmith Doctrine for consistency, right? And then, because your brain goes there, and that's great, I appreciate that it does, Code Section 1211, right, limits capital losses to the first $3,000. So your taxpayer A is not a happy camper. And taxpayer A is actually say, gee, I wish I hired someone with less talent because most people would have overlooked this and still reported it as 3,000 ordinary loss. But if you make a few zeros after 3,000 or 5,000, you're doing your client a favor in case they get audited. You're doing yourself a favor if you remember the Aerosmith Doctrine, because that's the right answer. All right? Everyone got that? All right. Consequences to the liquidating corporation, right? Now, second part was, well, if it had been paid by the corporation, what that meant is, what would have happened, instead of being $20,000 being liquidated, when it was liquidated, there would only have been $15,000. If there was only $15,000 and taxpayer A had a $10,000 basis, it would have produced $5,000 of capital gain, right, Mabu? So the answer, in other words, the answer here is 5,000 capital loss because it creates consistency.
So basically, it's better to happen before the liquidation.
It's absolutely better because then you don't have to deal with the capital loss limitation rules. Consequences to the liquidating corporation, right? Again, guys, the framework here is it's just good tax practice because it's just reflecting things you guys should know, I should know, is now we're going to have here, what are the effects of the corporation? 336, right? And Matt, you'll be glad to know we couldn't care less at this moment what the company's earnings and profits are. Not, on the exam, when I ask what are the effects on the corporation, Matt, you're not going to have to worry about me taking off points on your exam or anyone's exam about what are the effects of the corporation's earnings and profits, okay? So there's good news. You were looking for some good news tonight? There you go. You don't have to worry about the corporation's earnings and profits. You do have to worry about whether or not the corporation has gain or losses, but you don't have to worry. There's no second part of the answer. There's no effect to its earnings and profits. They disappear. No. For this narrow question of liquidations. Okay? Now, 336 talks in general terms about gains and losses that I'm about to knock my own book down. Gains and losses shall be recognized. And the big issue here is 336D, okay? Because we know Congress is always circumspect with respect to losses. And I forewarned you of this, right? I tried to give you a hint that if there was any complication with this segment of the chapter, it's 336D1 and D2. Okay? So, for exam purposes, if there's material here to be gathered, to be careful about, D1 says no loss recognized in certain distribution to related persons. Okay? Related persons. Where do you figure out if you're related or not? Last I checked, most of you don't think you're related to a corporation, right? But are you? And the answer is yes. And Fatima, where do you find that? How are you related? How do you know if you're related to a corporation? $267, right? 267 defines who's related and who's not. So, right? Everyone agree? That's a code section that we periodically look at. For example, for losses between related parties. If you look at 267B2, an individual and a corporation, more than 50% of the value of the outstanding stock which is owned directly or indirectly by or for such individual, okay, is the most common. Okay. 267B2. Okay? And it says, no law shall be recognized to a liquidating corporation on the distribution of any property to a related person if such distribution is not pro rata or if it's a distribution of disqualified property. What's disqualified property? Well, it's defined right below. Disqualified property means any property which is acquired by the liquidating corporation in a transaction to which Code Section 351 applied. Okay? And it was acquired in the last 5 years. This should remind you of some of our anti-stuffing rules, right? If someone wants to stuff property in, controlling shareholder in the prior 5 years, that's going to be, vis-a-vis a 351 transaction, disqualified property. Okay? That's D1, transactions to related parties. D2, special rule for certain property acquired in certain carryover basis transactions. Okay, and this rule talks about the fact that for purposes determining the amount of loss recognized by any liquidating corporation on the sale, exchange, or distribution of property described in B, the adjusted basis of such property shall be reduced. And what's the kind of property? Let's just look at capital letter B. This kind of property is property if such property is acquired by the liquidating corporation in a transaction in which 351 applied and the acquisition of such property on the liquidating corporation was a part of a plan, the principal purpose of which was to recognize loss. Okay, so remember 357B, if you transfer property subject to a liability to a corporation, it was subject, and one of the principal purposes was tax avoidance. Remember 357B? Evil befell, and that liability was treated as boot, all liabilities. Similarly, if you transfer property, and the purpose of you transferring the property was tax avoidance, and typically this will happen when the losses of property are greater, are in excess, the basis of the property is in excess of its fair market value. I'll repeat, if you transfer property, and let's just suppose the adjusted basis of the property is 300 and the fair market value is 100, and you transfer that property into the corporation, might you be looking to shelter income in that corporate enterprise? I'll repeat, if you transfer property with a basis of 300, fair market value of 100, hint, hint, there's an embedded loss of 200,000. Agreed? You look kind of suspicious when you do that, particularly if that property has no relationship to the corporate enterprise. For example, there was an example the prior edition had where in the congressional history, suppose you own a radio station in New Jersey and you transfer real estate in Nevada. Is there any relationship to that real estate to the corporate? It has a bad aroma. Now, suppose you own a radio station in New Jersey and you transfer property, some sort of intellectual property with an embedded loss, some sort of music or something else, and there's some sort of relationship between the two. You may be doing that just to try to make the corporate enterprise survive. It may not be your primary agenda to secure a tax loss, that might work. But if there's no relationship between the contributed property and the corporate enterprise, and it has an embedded loss, that looks suspicious. Agreed? Now, some of you are thinking, and I like the way you think, some of you are thinking, gee, I'm contributing, or the controlling shareholder is contributing lost property to a corporation in a 351 transaction, and your brain is firing, meaning your synapses are firing, and it's firing to what code section when you hear me give that description? 362E2, right? If you recall that if you have property in which you have an embedded loss, agreed, that 362E2 under, I'll call it new law, says that the corporation can't take that larger basis, right? Your basis is capped, the corporation's basis is capped at fair market value, agreed? Everyone agree to that? Unless the shareholder makes an election and things like that. So you might, and by the way, you'd be right to think that way, because generally now, and the authors of our textbook make this point, the authors say, you know what, when Congress does a lot of tax legislation, the code is very complicated. There's some very bright people who work on this, so I don't want to sell them short. But once in a while, when they're at the last minute, they're putting in code sections to raise a few dollars here or subtract a few dollars there, they miss things. And the authors of our textbook say, gee, maybe when they put in code section 362E2, they should have eliminated this code section 336D2, all right, that it doesn't serve as much utility. You're right, that maybe that should have been the case, but you could have, if you recall, and I should have probably done this before class, but let's just think about one thing about this, that if you contribute property, say with a $100,000 adjusted basis, fair market value of $900, okay? And you contribute two pieces of property, and the other piece of property has adjusted basis of $400,000, fair market value of $100,000, okay? Does code section 362E2 apply in this context? No, right? Because the adjusted basis here is $500,000, and the fair market value is $1 million, right? Right? 362E2 does not apply in this context. Agreed? So if you contributed, you're the controlling shareholder, and the corporation is faltering, foundering, and you contributed two pieces of property, this piece of property could still be subject to 336D2, right? Because maybe you're stuffing in gain property but simultaneous loss property, and this was tax motivated because it has no relationship. So I don't want to put the nails in the coffin to code section 336D2, even in the aftermath of code section 362E2. I sound like I'm talking about alphabet soup, but I'm assuming that you guys can follow me because you're really good at this. All right, so your antenna, if we're talking about lost property, and you see it on the exam, you should be focused on 336D1 and D2, because those are the ones that me, being the tricky professor that I'm not, because I'm telling you this right now, that's where students blow it.
On the flip side, they put the 267 provision in here as related to the corporation loss, but could it apply to the shareholder side?
Just state your question. Christy's raising a question about code section 267, saying it applies to the corporate side.
The book references it as applying to the corporate side.
Okay.
But I'm saying, couldn't it also apply to the shareholder?
Give me an example of where that might apply.
Well, if the shareholder is a 50% shareholder,
And
and
you're
he had a loss
liquidation.
on the liquidation.
Christy's saying, suppose the shareholder, in our example, had a basis in this example, instead of 10, 30, and now they get $20,000 in liquidation. Agreed? And it has an aroma of being, gee, here's a related party, right? And you know they're related, right? They look related, right? I mean, even though one's a circle, one's a square, but they're related because they're 100% owner, right? Everyone agree? Under 267? But 331 rules, because 331 says you get the loss and it doesn't cross-reference the application of 267. And 267 is not a universal provision, it's one that only applies when it's told it applies. All right, so you would get, it doesn't work the flip way. It's a good question, but it just doesn't, it only works one way. Okay, and the way it works is the shareholder can get the loss, but if the corporation, with respect to any property that's being distributed up here, 336 D1 treats A as a related party and may disallow some of the losses. I don't know what you mean with stay at. We need to know more of what the assets are. We have no clue what the assets are here. All right? All right. So, let's look at, so keeping that in mind, now, the authors do give you some history here. The history that the authors give you is that it used to be, prior to 1986, which, again, for exam purposes, Jean, you're listening to me? Exam purposes, you're supposed to perk up. On Saturday, don't worry about pre-86 law, okay? Is that the authors say pre-86, it was not hard, in many instances, to potentially liquidate, right? Liquidate the entity and secure or limit your tax exposure to tax at one level, okay? That Code Section 336, 337 worked in a way that there could be tax avoidance, okay? That liquidations were one avenue during the life cycle of a corporation to ultimately avoid corporate tax, all right? And what we learn is post-86, Congress said, you know what? Subchapter C is a double tax regime. You got to pay the piper, okay? Vis-a-vis two code sections, 311 during the lifetime you're going to pay, and at liquidation, it entirely eliminated what was formerly known as the General Utilities Doctrine, all right? But we see vis-a-vis page 324, Commissioner v. Court Holding Company. And here this case is written by Justice Black, and it's not a hard fact pattern to follow. We have an apartment complex which was owned by two shareholders in a corporation. The corporation owned the apartment house, and the shareholders got tax counsel what we'll call too late, right? Because they learned probably halfway or three-fourths through the negotiation that if they wanted to be smart, they should liquidate the corporation, get the corporation in their individual hands, and then sell the apartment individually. In this way, they would have eliminated the corporate tax. So what do? They do just that, or their tax advisor tells them, go out there, liquidate the corporation, and sell the asset in your individual name, and you'll avoid the corporate level tax. And is the court receptive to this, where they quickly liquidate and then they sell it individually? JP, does this work? Who prevails? Why? You're not sure? Kevin, how did your prior owner do on this book, or you do on the book? So they didn't do too well here. Akash, did you have a chance? You guys tell me, in this case, Shahid, you get a chance to look at this? Not a hard case to read. I mean, here the IRS won at the tax court level, at the appeals court level, the taxpayer won. And essentially, Justice Black here says this deal was essentially completed in the hands of the corporation, okay? The corporate enterprise had secured the outcome here, all right? And that being the case, factually, you can't reverse what already happened. In fact, I don't think it's pointed out. Oh, yeah, it was. Well, $1,000 had already been paid to the corporation, and now they're trying to reverse what had happened. So the court essentially rules here that this is a step transaction, and it was a meaningless step, right, to liquidate the corporation and then have the individuals sell it, all right? So the IRS is able to invoke the step transaction. Now notice, the year this case is rendered, 1945, look at 5 years later, half a decade later, page 326, 1950. We have Cumberland Public Service Company, okay? Who writes this opinion? Same justice, okay? And the facts are essentially the same. However, who prevails in this case? The taxpayer prevails in this case. Why? Because the court rules factually that this liquidation or the sale was not as far along. Okay? In the prior case, the sale was essentially a done deal. But here, that was not factually the case, and the taxpayer, under the auspices of a taxpayer can only always minimize their tax if they find a better way. The court said, gee, since the sale here was not really complete, that there was no problem with the taxpayers liquidating once the apartment complex was in their name or whatever they were selling, that was okay, and that works. So, I mean, for our purposes, these cases are not entirely that important, but they do illustrate that liquidations were a way that taxpayers used to avoid the corporate level tax, okay? And that in 1986, Congress says we're going to not rewrite the law, we're going to overhaul it and force a recognition of it, okay? So these cases are still relevant for judicial doctrine purposes, that there is a step transaction doctrine and that substance governs, not form. But for purposes of our purposes, they have no applicability any longer with respect to liquidations. Beginning on page 331, then, you really have to hone in your attention, because here is the new law where the authors describe distributions to related persons, right? We know there's limitations, significant limitations. And these are spelled out on page 331, 332, 333. And then the italicized language beginning on page 333, dealing with losses with tax avoidance purpose. Okay? Congress is going to put the brakes on those. So we have a tough road to haul, because we have to, gains we know, right? No problem recognizing gains. Agreed? Gains are always going to be recognized. But the losses, we have two potential barriers, 336 D1 and D2. Let's just take a very quick glance at this problem on page 335, and then we'll take a break. Let's just get ourselves oriented. We have on page 335, all the outstanding stock of X is owned by Ivan, 60 shares, and Flo, who are unrelated. That's important, right? Because if they were father-daughter, 318 might apply, and we might have other issues. Because, right, well, we'll see in a moment. X has no liabilities in the following assets. We have gain acre, loss acre, and cash. Remember, your clients will not always be so kind to name their property with those names. In my margins, I've written down that on gain acre, there's a potential $300 gain. Loss acre, there's a potential $400 loss. And cash, there's nothing. It says, unless otherwise indicated, assume that gain acre and loss acre have each been held for more than 5 years. Why do they put held for more than 5 years, guys? that it's not disqualified property under Code Section 336D1. All right? On January 1st of the current year, X adopted a complete plan of liquidation. What are the tax consequences to X on the distribution of its assets pursuant to the liquidation plan in each of the following alternatives? Okay? So what we're going to see is, or the authors want to direct our attention to, is whether or not the gain under 336A, let me give you a hint, the gain is not going to be the issue. Congress has no problem with taxpayers recognizing gain. Agreed? The more, and again, notice that the first part of this chapter was centered on the shareholder. This part of the chapter is centered on what's the effect to the corporation. Gains will be recognized. The question is, you see that loss in loss acre? Will it be recognized? So, I'm going to leave you in suspense. Why don't we take our 10-minute break tonight, and we'll go from there.